Hi, this is Jim Cunningham. Today, we're going to talk about the 2026 tax exemption change, the sunsetting of the very favorable death taxes that we have in the United States right now. And there presents opportunities and risks for many people in the United States, typically higher net worth people, and it really does impact your estate plan. I do have Shannon Beahan and Christina Lindsey Orta from Ascent Wealth Management here joining me today. Welcome, Shannon and Christina. It's always great to see you here. And this is so important, isn't it, to in terms of talking to clients, it can be very confusing. Like, well, what's the law now? And is it going to change? Will it change? You know, who knows, right? Back when the Tax Cuts and Jobs Act was passed, TRJCA, right, under the Trump administration. And we mentioned administrations, not from a political standpoint. So I'm just saying when it happened. So this is 2017. It did not get 60 votes in the Senate. So when this tax relief bill was passed, because it did not get a necessary number of votes, which is 60, this bill sunsets, meaning it goes away. Like the sun sets at the end of the day, right? When the day's over, the sun sets, it's over. This tax law also has a sunset provision. So all these tax laws end December 31, 2025, just before you ring in the new year. And you really should figure out, is your estate plan prepared? You know, is this something you need to deal with in your own estate plan? Maybe someone else's estate plan. And if it is something you need to deal with, this is very, very important. And we're going to talk about primarily one structure, Christina and Shannon, one structure that has been used in the past before we had this expansion of these much larger and frankly generous abilities to pass, 12 million in assets, 13 million in assets now for each person. Before it used to be 600,000 when I started practicing law. So just kind of give us a little context of how life insurance is used to pay taxes, and maybe just tee this up before we get started.
Yeah, so we're going to kind of go into a little bit about what is an irrevocable life insurance trust. So we are going to get into what is it, how to fund it, how it works. But we first kind of wanted to understand what's the problem. It's that there is this sunset. And I want to be clear that this is the federal estate tax. There are also state estate taxes. And for example, Jim, what's the estate tax in Washington? In the state of Washington, I think it's on anything over $1 million, isn't it?
But Oregon's up to 16% over $1 million, and Washington's like 2 million and change, but it's 20%. So for people who say, yeah, I'm going to move to Washington, I don't have any state income tax, I'm going to move to Walla Walla and then cross the river to go shopping in Oregon, so I don't have to pay no income tax in Washington and no sales tax in Oregon. I got this thing beat. Yeah, well, they're going to get you in the end. So it's something you need to pay attention to. You're much better off, frankly, dying in California if you're married, or dying in California in general, as opposed to Oregon and Washington, sort of all things being equal. Well, I'm Jim Cunningham. I'm a partner at Cunningham Legal. I've got over 25 years experience, offices throughout California. It's 25 years throws me because I never thought anyway, whatever. It's a long time. Real estate broker, certified specialist in estate planning, trust and probate law, securities and insurance licensed, and a pilot. These are the lawyers in our firm. We are entirely focused on helping essentially the mass affluent deal with trust and estate issues, whether it's a family-owned business or any type of trust or other estate planning matter. That's us. And then we have Christina and Shannon joining us from Ascent Wealth Management, and you're both CFPs, certified financial planners, which is really, really important. And you know what, Christina and Shannon, you know this and I know this, but somebody listening to this or watching this might not know, not many women are certified financial planners, right? I mean, what's the percentage of women who are certified financial planners?
It's about 15%, I think, of the overall industry.
Yeah. Yikes. If you're watching this on YouTube or listening on our YouTube, go ahead and subscribe, and you can click the little bell and it will alert you when new videos are published, typically Thursdays at 6 p.m. Pacific time. And you want to talk a little bit about a disclaimer here, Christina or Shannon?
Yeah, most importantly, that this certainly every individual client scenario is a case-by-case basis. We want to make sure that we're not giving any advice here that should be construed as advice, and there's no guarantees. We certainly want to make sure that every single illustration that we're giving here is for hypothetical understanding purposes, that we want to make sure that we're meeting with every client and making a recommendation on an individualized basis. And, this most insurance, life insurance is not a security, but we do have our securities licenses. So we do want to make sure that we make the proper disclosures that we're not here to sell any securities on this webinar.
And this is our legal disclaimer, and we will get started as soon as we get through the disclaimers. This is not legal advice. When I'm talking, I'm a lawyer. My lips are moving. Words are coming out of my mouth. Please do not take this as legal advice. Don't say like, hey, I heard Jim do this and I'm going to go out and do a bunch of stuff. You really do need to meet with a qualified, and I stress qualified, lawyer who specializes in this area, or they have a real deep background in it. So, why now? We're right as we record this, we're in the summer of 2023. There is a hurricane headed toward Southern California. I saw that on the news this morning. Crazy. Hopefully it won't be too bad. So why now? What's going on? 2026, gosh, that sounds like a long time from now, right? It's really not, folks. 2026, January 1, 2026 is really not that far away. In the estate planning world, these things take time. It might take months to do certain plans, right? Might take a few weeks to do other types. But this is something very, very important to understand. 30 years ago, when I became a lawyer, next year, this 30 years, you could leave $600,000 free of death tax, right? Free of estate tax. And when I use the term death tax, I'm not using it in a political sense. I am describing the bundle of taxes. And Christina made this point. When I say death tax, I mean state estate taxes and federal estate tax. So these are taxes that kick in, that there's a stopwatch that starts when a person dies, hence the term death tax. So right now you can leave $12,920,000 tax-free. That is a huge amount of money. That's way bigger than $600,000 when I started, even factoring in inflation. And this is going to get cut in half. So what's going on here is in 2011, during the Obama administration, we all got a $5 million exemption. So you can think of a layered cake, a cake with frosting. The cake, this is the Obama cake, is $5 million. And that $5 million was indexed to inflation. In 2017, during the Trump administration, we got some frosting on that cake, which means that Trump frosting, that's another $5 million plus inflation going back to 2011. So when you put those two together and think of this as a layered cake, that gets you $12,920,000. If a person makes a taxable gift, this is a gift beyond $17,000. If a person makes a taxable gift of $1 million, it comes off the Trump frosting, not the Obama cake. And this is very, very important. So if you have an estate and you're thinking, gee, there's this $5 million exemption that was passed during the Trump administration, I want to take advantage of it. You don't give it out of the Trump frosting. It comes off the Obama cake. So it comes off your oldest exemption first. So in order to make a gift that takes advantage of this extra Trump administration exemption, right? This frosting, you have to eat all the cake first before you hit the frosting. So you're not slicing it sideways. You're not taking the frosting off first. January 1, 2026, the government is coming in and they're scraping the frosting off of that cake. We are left with the Obama cake. That is a $5 million exemption plus inflation, probably going to be somewhere between $6 and $7 million if we had to guess. We're kind of guessing with inflation. But it's very important to understand that for many people that reach out to us, they happen to be in this, they're in between 6 and 12 million in wealth, or if they're married, they're between 12 and 24 million in wealth. So for many people, gifting simply doesn't make sense. And so many people are looking at gifting strategies. If you have an estate of 30 million and above, or 20 million and above, or maybe if over 10 or 12 million, if you're single, it might make sense to make gifts. But a lot of people are uncomfortable with making those gifts. What we're going to unpack here is a strategy that gives your estate liquidity when you pass away. So when somebody passes away, you have that liquidity, you've got that cash to pay the tax. And as Christina and Shannon are going to show you, it's a way of paying the tax that you're going to pay anyway, but for really kind of pennies on the dollar. So you're paying it ahead. And also don't forget, as Christina mentioned, the state death tax. If you live in California and you have a vacation home in Oregon, that is included in your estate for Oregon death tax purposes. And they put that on the top. So if you have $1 million estate in California and a $100,000 home, probably more than that, in Oregon, once you go over this $1 million threshold, you're subject to Oregon inheritance tax up to 16%, and they count your California assets. It's very important to understand that's kind of on the top. So that's the state issue.
And the other thing that I'll want to highlight on the state issue is the state issue could also be a reason why you might want to look at an ILIT to help fund the state estate tax.
That's correct. That's the ILIT, the Irrevocable Life Insurance Trust. So, and it's also important to understand this is due 9 months after death. So imagine, if you've ever lost a loved one, time goes by really fast and there's a lot to do. And then this sort of sneaks up on you. And I know of one case where not our firm, another law firm missed a filing deadline. The penalty was $2 million to the estate. Okay. So these are serious penalties, like they missed it by a day, $2 million penalty. So there are heavy penalties, and these taxes are due 9 months after death.
And before we get into just a little bit more detail too, looking at those charts, when we're looking at those limits, one of the things I want to mention that a lot of times we don't think about, but inheritance. We've got quite a bit of wealth transfer taking place as we have some of the baby boomer generation, the older baby boomers, as well as the generation that is above them, that are passing away and transferring wealth to existing baby boomers and Gen X. And so if some of that wealth transfer wasn't in the form of certain types of trust planning or generation skipping trusts, which is not what this webinar is about, but I do want you to think about, hey, what if I have some inheritance coming my way that I might only have a, $5 million estate today, but I'm inheriting all this real estate. And real estate, a lot of times people don't think about as much as the valuation. It's illiquid. So there's no way to just tangibly go sell that to pay the estate tax due. So a lot of times these numbers are comprised of also inheritance and real estate that's not necessarily liquid to pay the tax due.
Yeah, I mean, you raise a really good point, Christina. And then the other thing is sometimes people don't want to sell, or it might be a bad time to sell, or or if you're like, if you have a family farm, you don't want to sell that. That's your livelihood, and yeah, can you pay the tax over time? Yes, if 35% or more of your estate is illiquid, but you still have to pay the tax. That's really key. You're still going to have to pay it, and there's some interest attached to that. All right. So, well, basically, okay, so the last iteration of estate tax was passed during World War I. The stated purpose, this was 1917, which also happened to be the year of the communist revolution in the Soviet Union, in Russia. 1917, the estate tax was passed. The stated purpose of the estate tax is to redistribute wealth. That's it. That is the purpose of the estate tax. It's to say, those people got really rich, and it's time that when that person dies, that needs to be redistributed. Unfortunately, it's not going to your friends and neighbors. It is going to the US government. So that money goes to the US government, and then they spend it. So what they do is the idea behind the death tax and the wealth transfer tax system is if you're wealthy and you say, gee, I'm going to pay this death tax or my state's going to pay this death tax when I pass away. Gee, maybe I can give some stuff during my lifetime. Well, they're going to tax you there. You can give $17,000 tax-free without having to file a gift tax return. And if you give $117,000 to one person, you have to file a gift tax return, probably no tax due if you haven't fully exhausted your exemption. But something important to understand is you can give up to $17,000 per recipient per year. If you give more than that, you have a reporting requirement on the Form 709. Generation skipping, Christina, you mentioned this. This is very, very important. If you're going to inherit a substantial amount of wealth, it's really important to consider having that in a generation skipping trust. It does not necessarily skip you. So if you're the kid going to inherit from parents, that the term generation skipping trust is a really bad label for that trust. A lot of people hear it as a dynasty trust. That means that if I'm the kid and I'm inheriting from my parents in a generation skipping trust, it does not skip me, but it takes advantage of this generation skipping transfer tax coupon that lets somebody leave up to $12.92 million to me in a trust. And then when I die, that $12.92 million is not included in my estate. And so, Christina, and that could grow to $100 million and it's still not included in my estate. So this is a very powerful tool. By the way, if you're wealthy or you come from a wealthy family, this might be familiar to you, right? You might have heard of this. If you don't come from a wealthy family and you made a lot on your own, this may all be all new to you, right? So you can take advantage of certain tax laws that are very favorable right now that are going to go away December 31, 2025. So January 1, 2026, it's going to be all different. All right. I keep talking. I'm going to just talk about components of a taxable estate. I promise I will turn it over to you. What's included in your taxable estate? The technical term is gross estate. Gross meaning big in German, right? Gross, or I guess French, gross, right? Same word. Big. This is your big estate. This is your taxable estate. This includes the equity in your real estate holdings. All right. So it includes a full value minus the debt, if any. It includes your business interests. So if you have an operating business, the government's going to say you need to value that and you need to potentially pay tax on that business interest. Real estate, not liquid. Business interest, typically not liquid, right? Personal property. If you're a wealthy individual, the government kind of assumes you've got some personal property. Art, collectibles, gold coins. That's all included. Doesn't have a title per se, but it is included. I mean, auto would have a title. Even automobiles are included. Investment accounts. That's Christina and Shannon. You know a lot about investment accounts. All your stocks and bonds and mutual funds.
Which
Life
includes
insurance. Yeah. Sorry.
IRAs, which includes
IRAs.
and 401ks.
That's right. So IRAs and 401ks. So if I have a $5 million IRA and I've got a $20 million estate, that is a toxic asset. We've covered this in other webinars. It's a 90% tax, 90, right? You got 40%, potentially 45% death tax, plus about 50% income tax, and you don't get a deduction or a credit for paying one before you pay the other one. So hear me, if you have a large estate, if your estate's over 12,920,000 and you have IRAs, 90% of that IRA will end up going to tax, unless of course it's a Roth, then it's only 40 or 45, still a lot. Life insurance. We're going to talk about a lot about life insurance that is owned by a decedent, meaning if I take out a life insurance policy on me, I'm the owner, I make my wife the beneficiary, that's included in my estate. If an irrevocable life insurance trust owns that policy and it's set up correctly, that is outside of my estate, right? So if I have a $5 million death benefit, my kids don't want to be paying $2 million in death taxes on that $5 million because that's 40% of $5 million. It would make sense to have that outside of my estate, so my kids would have the full benefit of that $5 million death benefit. Revocable grantor trust is also known as a living trust. A revocable grantor trust is kind of this typical living trust. All the assets in your living trust included in your estate. That a living trust is kind of like a super will that avoids probate. It has a lot of good features, not a whole lot of death tax planning or estate tax planning, if this is you and your living trust for your particular estate. Also, here, assets under what's called a general power of appointment. So if you hold the power to appoint the property to yourself, your estate, your creditors, or the creditors of your estate, and that's the measure, that is deemed a general power of appointment. Those assets are included in your estate as well. So your parents may have set up an estate plan for you, and that money may be in a trust that maybe your parents set up. And if you have a general power of appointment over that, then those assets are also included in your estate. So a lot of gotchas in there. This is why you need an expert, not DIY. This is not for amateurs, not amateur hour, or, general practitioner hour. And the other sort of legal aspects to this, if you're married and the surviving spouse is a U.S. citizen, caveat is a U.S. citizen, there's something called an unlimited marital deduction. That means if you have a billionaire couple, one spouse passes away, the other spouse inherits $1 billion from the deceased spouse, no tax, right? And in California, if it's held as community property, it gets a full adjusted cost basis. So this is also very important. And this is really one of the great things about being a resident of a community property state. To the extent you hold property that's community property, when one spouse dies, you get a full adjusted cost basis. That means if you bought something for $1 and now it's worth $10, the surviving spouse can sell that asset for $10 and avoid capital gains tax. Now, if you add a few zeros on there, those numbers can get pretty big. There's also an unlimited charitable deduction, meaning if you leave assets to charity at your death, that's not taxable, right? So a lot of people will leave their IRAs to charities, right? They go, gee, if it's 90% tax, I'll leave that IRA to charity. That makes way more sense. That makes way more sense than leaving the assets from your living trust, right? So I had a client come in years ago. They said, we're leaving $5 million to charity. We're leaving it from our trust. I said, you have $5 million in IRAs. It makes sense to not leave the IRAs to your kids, but leave the IRAs to the charity and leave the other assets to your kids. And that saved the family, a couple $1 million in income tax. So just some basic, I would chalk that up as to sort of basic advanced estate planning hygiene. Mm-hmm. And then during your lifetime charitable donations, it depends if you're giving cash or you're giving an asset with a low basis. And, we cover that in other webinars, but you can take an income tax deduction on that. You can also make direct lifetime gifts to people up to $17,000 for 2023. If you make a gift of greater than $17,000 to a non-charitable beneficiary, there's a reporting requirement, not necessarily tax due per se, but definitely a reporting requirement. And then you want to talk, well, medical and tuition reimbursement. If you pay the tuition directly to the institution, it's not a gift for your kids. But if you pay off their student loans, yeah, it kind of is a gift. If you pay that money directly to the medical institution, it is not deemed a gift. But if you reimburse somebody for a medical expense, it is going to be a gift. And then this is a nice segue, the irrevocable trust with the crummy power. Crummy power was a case that was handled out of Sacramento, believe it or not. And many, many years ago, crummy does not reflect the quality of the crummy letter. It is the family's name, crummy, Crummey. Great name, great case name, crummy letter. And that's where, in order to qualify for that $17,000 annual exemption, you have to give the people who are the beneficiary. So if mom and dad do an ILIT, an irrevocable life insurance trust, and they have 3 kids, each kid gets a letter saying, mom and dad have put $17,000 into this trust. You have the ability to take this money out for the next 30 or 45 days. And then you have to tell the kids, hey, don't do that. Right. But that qualifies for the annual $17,000 exemption. If you don't have a crummy power, then you're burning. You might have to file a gift tax return.
And we'll get into some of the details of the crummy letter and how the ILIT works and administering an ILIT and the importance of having an ILIT administered appropriately. But one of those lifetime gifting strategies as well that you mentioned is $17,000 per year per beneficiary. One of the things that's also overlooked is 5 to 9 plans or college funding, education funding, and which can be a multi-generational education trust. So if your current grandkids don't use it for their education, the next generation could use it. It can continue to grow tax-free, it can go multiple generations. But for people that are looking to do lifetime gifting and get more out of their estate, they can do a lump sum of 5 years at a time. So they can do $85,000. They can front load 5 years. Now, if they die within that 5 years, some of that gifting comes back into the estate. But for all intents and purposes, you can gift 5 years of education funding, $17,000 per year for 5 years. So $170,000 for a married couple. If you're gifting a 5 to 9 education fund, you can do $170,000 as a married couple per grandchild to get more money out of your estate.
It's interesting you say per grandchild because thankfully, I have 2 daughters who will be finishing college this fall and next spring. Thank goodness. So if you're a grandparent and you want to provide an education for your kids, that's a really great strategy that Christina mentioned. And what it is, you can do $170,000 per couple per grandchild, basically. And that's not included. My understanding is that currently, if it's in the 3rd or 4th year, it's not counted against the student for FAFSA purposes, although they are rewriting those laws. So, it remains to be seen, but still, it's a great strategy. Student loan debt is just a real hard thing for young people. I mean, it's hard enough being a young person now. And the gift of education, we've covered that in other webinars. Just really fantastic. I'm glad you mentioned that, Christina. So I'm going to let you guys talk about the benefits of irrevocable trusts. An irrevocable trust is what it says. It is a trust that you cannot change, right? You cannot amend, you cannot revoke. So it's this trust that's set up, it holds life insurance, and then money is put in typically to this trust. And it's like a gift, right? It's like a gift that the kids get when you die. So it's kind of putting it in almost like a bank account in a sense that you're not going to make withdrawals from, right? So this is very important to understand. The money goes in and it does not come out until the person who's kind of making that gift passes away. So it's a very long-term strategy. Many, many clients do this. I would say I would on the horizon 2026 and later, we're going to see a lot more of these because a lot more people will be subject to the death tax. But Shannon and Christina, take it away.
So as far as the ILIT goes, some of the main reasons, as Jim had touched on, is you want the death benefit to be outside of the estate. So if there's any, if the owner is the insured and the insured person is the owner of the policy, that would be includable in the estate. So on no circumstance for a highly valued estate do you want the ownership to be tied back into your estate at death. So the whole reason for this irrevocable life insurance trust is so that this death benefit will be there to cover the estate tax due. So that if there's an estate tax due, we've got several clients that we've seen this happen with. We're currently working with a client that I think 20-ish million of the estate is real estate, very illiquid. Then we've got about 4 million liquid investments. Well, if that continues to compound and grow and it's a single person, this is going to be a fairly hefty estate tax due. If you figure 45% on anything over, call it 6 million adjusted for inflation, if the law resets in 2026, we could very well be looking at $20-30 million. That 45% of that is the assessed tax. But if most of that estate is real estate that you can't readily sell, and that estate tax is due within 9 months of date of death, how do you pay the bill without doing a fire sale on the real estate?
Christina, you're raising really good issues. And I think if I were listening to this and I did not have the knowledge that I have, I would say, well, gee, couldn't we just be making gifts of property before? Couldn't we just gift these property ahead of time? And one solution that the life insurance track or path offers is it helps with what lawyers and CPAs and financial advisors call basis management. So this is really, really important. Many of our clients make a gift of property while they're alive. Now, if it's a married couple, that might make sense. The issue, when it's a gift, the people who receive that gift, whether it's in trust or outright, get your low cost basis. So many of our clients with real estate holdings have very low cost basis. It's really great if when one spouse passes away, you get that full adjusted cost basis. You're wiping out a tremendous amount of capital gains tax. And that really, I would say this is not a one size fits all strategy. For many people, if you have a lot of real estate, many people do look, frankly, at life insurance. You also now have these Prop 13 issues, Prop 19 issues. Are you going to get reassessed if you transfer property? So I want you to, as you're listening to this, think about the adjusted cost basis that you get at death. So if I die and I have an asset that I paid $100,000 for that's worth 10 million, my kids can sell that for 10 million and not pay any capital gains tax. If I give them that asset before I die, they're going to pay capital gains tax on 9.9 million, which is about 3.3 million. So that's a crazy amount of savings. So it's this basis management, this cost, this death tax versus capital gains, and life insurance in many, but not all, in many situations is a good solution, but it's not for everyone. So, but it does offer great benefits: creditor protection. You're bypassing probate. You're creating a legacy, estate liquidity. Even if, hey, let's say the government says, hey, we're getting rid of death tax, we're going to do something else.
And the other thing that they're
going to get the money, right? They're going to get the money. It's great. Yeah.
Yeah. The other thing that's on here too, that I want to make mention of is incapable beneficiaries. There are some clients where we've got a child with special needs, and we might be dealing with a taxable estate where there's a huge erosion of what's going to be transferred to fund the special needs child because you're paying so much in estate tax. So, the other thing that this does provide for is liquidity in an estate to cover the aid for caring for a loved one that might have special needs. So there are many different reasons as to why we would look at an irrevocable trust, creditor protection. All of these things are reasons why we'd look at it. And Jim, you mentioned basis management, which we're going to get into a couple examples of that. But how does an ILIT work? And I'm going to have Shannon kind of go through the basis management in a minute and talk about that case study. But let's just break it down. How does an ILIT work? So an ILIT is just what it says. It's an irrevocable trust. The reason why these are typically really highly utilized and preferable is it also doesn't require a whole lot of tax burden during the lifetime, because there's no income tax, there's no dividends, this isn't a type of trust. All it holds is life insurance. So there's no annual tax filings. There is a lot of annual maintenance. That's important, but we do want to make sure that you understand that there's not a lot of tax. There's no tax being paid along the way. And as long as that death benefit comes due inside the irrevocable trust, that's going to be a tax-free death benefit. That's going to be income tax-free. It's going to be estate tax-free, and might be something to provide liquidity to the estate to pay any estate tax due. So this trust is created. Cunningham Legal creates the trust, creates the trust that's going to own the life insurance. There still has to be an insured person. So the grantor typically is going to be the insured person that's going to, you still have to have the ability to qualify for life insurance. So sometimes you might have a husband and wife that's on the policy. And if you have two lives that are insured, that's typically, if they're both of good insurance rating, if they're both of good health, no history of cancer, not a lot of major issues there, no heart disease, that's going to typically be cheaper if we have 2 lives insured, and then the death benefit doesn't pay out until both lives have passed. But sometimes you might only have a husband that's insurable or a wife that's insurable. So husband and wife could be the grantor, the ones funding the premium payments, but you're going to have someone that's the insurance, that's the life insurance is on one or both of those lives. They're then gifting the annual premiums to the life insurance trust to pay the insurer. So they're going to pay the insurance premiums. There's going to be a trustee. We do not recommend that you try to do this yourself. We don't try to recommend that the grantor be the trustee or do it themselves,
right?
Because there is what we call those crummy notices. There's annual maintenance that has to be done to make sure it qualifies to stay outside of the estate. You have to do these notices annually to the beneficiary saying, we gifted you $17,000 a year. We don't know what the premiums are going to be, but we gifted this amount. We're using our lifetime gifting exemption or our annual gifting exemption to gift the premiums to this policy. This is for your benefit. You technically could pull this back out. Again, you don't want to do that. But then the death benefit, when the grantors pass away or the insureds pass away, the death benefit is inside this protected trust, tax-free from income tax, tax-free from death or estate tax. So that's how the kind of the mechanics of this work. But having a proper trustee, sometimes people think, well, I'll just name my kid the trustee. Again, because of the annual maintenance involved, the last thing you would want to do is have anything that could risk this death benefit getting pulled back into your taxable estate.
Yeah. Christina, as you're talking, I'm just thinking of so many instances where people have screwed stuff up, quite frankly. And it's too important. And it's really not, fees wise, it's not a whole lot. And I'm sure people ask us, well, how much? And they're always change. But let me just say, they're not that much. And you're typically going to pay a trust
$1,200 a year, maybe.
Yeah, trust company. It makes a lot of sense. The other thing too is on the back end when and the grantor, by the way, is the person who's going to die, right? With the estate tax liability. What happens when that money's in the life insurance trust is that life insurance trust typically will purchase assets from the estate or will lend money to the estate to fund the tax obligation. So it's not that you're avoiding tax, but you're providing liquidity to pay the tax. And many times those life insurance trusts, ideally, they are aligned with your living trust. So they really have to be, it really requires coordination between the life insurance trust and the living trust. And it's very important to understand that without that coordination, you can have an unanticipated or unintended kind of negative result that's not consistent with your wishes. So you really do need to pay attention to it.
Mm-hmm. And maintaining an ILIT. So we kind of spoke a little bit about this just now, but, administering the trust, sending the annual crummy letters, making sure that the trust is paying the premiums. And sometimes there's premiums that are due. I'd say more often than not, it's a finite period of time. Very rarely will it be, okay, Jim, we're insuring your life right now for an ILIT and you're going to pay premiums the rest of your life every single year. Usually it's going to be a finite period of time, like a 5-year schedule or a 10-year schedule or a 15-year schedule where this particular schedule of premiums has to be paid. So the trustee is going to ensure that the premiums are getting paid, that there's no lapse in the policy that would all of a sudden risk your death benefit going away because you didn't pay the premiums. But the other risk is making sure that the policy is performing as intended. So some policies are guaranteed, some policies are not guaranteed, some policies are dependent upon how they're funded. The important thing is that there's a trustee. What they're also going to do is make sure that they're looking at the policy each and every year to make sure it's performing, that there's no risk to that death benefit paying out, that there's enough cash value in the policy, that it's still guaranteed. If all of a sudden the client's now living to age 105 and it was only guaranteed to age 100, is this going to be a policy that'll still pay out? So the trustee is going to check all those boxes and make sure also, what if now with the amount of cash value in that policy, we can get a higher death benefit because the life insurance market has changed.
Right.
So the trustee is going to also look at that policy and go, hey, circumstances have changed. We might be able to take this $500,000 cash value that's in your policy, and you might have $1 million death benefit today. We might be able to go take that same cash value and go get you a $2 million death benefit or a $3 million death benefit without putting anything additional in premiums into the policy. Sometimes that happens. So the trustee will review the policy. They're going to file any potential returns needed upon death. And they're going to distribute the proceeds to the appropriate beneficiaries, and making sure that whoever your original beneficiaries and who you intended this money to go to, your wishes are adhered to. So maintaining an ILIT is important. It's not just set it, forget it. Policy selection does matter. And this is kind of some of the things that we look at when Shannon and I and Alyssa and our team, we're looking at every single client. We're looking at their insurability, what their health risks are, what carrier makes sense for them. The nice thing is, because we're independent and we're fiduciaries, we're not beholden to one company. We're not beholden to, we don't work for a New York Life or a Mass Mutual or a Northwestern Mutual, where that's all we can sell. You know, we work independently, and we can go out to the marketplace and look at what is the best product, what is the best insurance carrier that's A-rated, that has the ability to pay the claims, that will meet the needs of this client's circumstances. So we will look at all of that. We'll look at, do we want cash value accumulation? Do we want any waivers of premium? Do we want to make sure that there's no lapse guarantee, so that if you live beyond your expectation of what the actuarial assumptions are, is this still going to be a guaranteed death benefit? So all of these things matter. And these are all things that we look at to make sure that it's also not going to be pulled back into your estate, and that your beneficiaries are appropriate.
Yeah, it's important. You know, it's interesting as you're talking about life insurance. A lot of people say, well, you know, don't you pay income tax on life insurance? Or no. And so it's very important to understand life insurance predates income tax. Life insurance was about like 1840, I think. We had income tax here and there, but we really didn't have our modern income tax until 1907 or 1913. So this life insurance is a contract. And what this means is, the life insurance company says, you pay me $10,000 a year for 10 years. And when you die, I'll pay your heirs $2 million. It's a contract. That's all it is. It's not taxable. And if you take this policy out and then die a short time later, guess what? Your family still gets a $2 million, right? So this is a contract. It's not an investment. And a lot of times it's hard to think. Sometimes it's hard to separate these out. And so that's the why behind why it's not subject to income tax. Let's see.
Shannon, I'm going to have you go through a couple of the case studies here.
Yeah. Happy to. I think this first one, I've heard both of you touch on this issue. We mentioned it on some slides before. This is really about that issue of liquidity in an estate. With both of these case study examples, we're really trying to just isolate one thing to illustrate why it's a problem and maybe how to come up with that solution. So in this particular situation, for someone whose gross estate, a large portion of that is based on their the value of their business interests. Let's say it was $10 million at the time of their death. We're in a situation where the estate tax exclusion has gone down to $6 million. We're in a situation pretty quickly where we are having millions of dollars of estate tax due because, in that business interest, there's, $4 million that is beyond the exemption amount. And if we have $2 million in estate taxes due and there's only $1 million in cash outside of that business interest, then you're kind of backing your heirs into a situation where they may have to figure out, how do we get the financing in order to pay these estate taxes that are due? And they could be looking at a situation where they're, forced to get out of a family business that the intent was always to pass it down to future generations. And this is something that certainly matters with business interests, but it could be a very similar situation like Christina mentioned earlier with the client we were working with, where they're having to liquidate real estate that maybe they never intended to liquidate.
Or a lot of times people will also say too, what if we just take a loan or a mortgage on the real estate? Well, when you're Jim, you can speak to this. When you're in an estate administration period, mortgage companies, they won't lend to a trust.
Yeah. Nope. No. Well, they'll lend to a trust. It's really expensive. So this is something to understand. Banks lend to people, banks lend to persons. Okay. And this is like a Mitt Romney thing, I suppose. This is going back a long way. corporations are people too, right? So LLCs, corporations, whatever it is, humans, those are considered persons kind of under the law. Trusts are not. So banks will lend to people, including corporations. Banks do not lend to trusts. As a general rule, they don't lend to trusts. So it's something very important to understand is if you need to come up with cash to pay, then you're going to find a constraint if these properties are in a trust. The other thing too is it in this example, under Internal Revenue Code 6166, you can engage in a payment plan with the IRS. There are some favorable interest rates, but it's still, and this is something that comes up quite a bit with clients and CPAs. So if you're watching this and be like, well, wait, couldn't you pay those over time? Yeah, you still need to pay it, right? You still need to come up with a lot of money, and the interest on $2 million is not a small number. So there still is this liquidity issue, and many of our clients do pay the tax over time, but they're still paying it. And very importantly, you're paying it in after-tax dollars, right? You're not getting, when you pay those taxes, you're not getting a deduction. That's after you've paid money on the tax. So this tax bill, it might not be a $2 million tax bill if you pay over time. It looks more like a $4 million tax bill because you got to earn 4 to pay 2. So you see where I'm going with this. Life insurance can be, not always, but can be a very efficient method of dealing with this tax problem that affects few people today. It might affect you. After 2026, it's probably affect 10 times as many people.
And before I have you go into this one, Shannon, because I do want you to this is a really important one, on a business interest, especially when there's illiquidity and the business is important to pass on to generations or what have you, it may be much easier for that business to do a distribution of income to pay the premium.
Mm-hmm.
So I'm paying a premium of $15,000, $20,000 a year for 10 years to provide that liquidity. Could be something the business could afford to do, is pay the premium, but not necessarily, provide liquidity upon death. So there's multiple different ways we can look at this. And this is really why there's no one size fits all. But the next situation I do want Shannon to kind of go through, because we kind of use this scenario of gifting basis.
Yeah, Jim, I think this really kind of helps us illustrate that issue of basis management. So in this situation, what we're kind of taking a look at is that question around, hey, I have these assets right now that I intend to give to my children. Why don't I just give it to them now? And in this particular situation, we're looking at $5 million of stock with $1 million in cost basis, meaning that you as the owner right now have about $4 million in embedded capital gains. That we're assuming a very conservative growth rate of 6% over 20 years, let's say, is the life expectancy of you as the owner of this stock. That puts the value of this stock at your passing at around 15 million. So Jim, to your point, kind of the true option one would be to just hold on to this stock inside of your estate, have that $15 million value be a part of your gross estate that of course taxes would be due on. The real benefit there to, let's say, your kids as the heirs is that they are getting a step up in basis on the full amount of that stock. So they would be able to turn around immediately to liquidate any of that stock worth 15 million to access that cash, to then pay estate taxes or whatever they needed to do, but they're not subject to those capital gains. So that's really kind of the true option one. And in that scenario, maybe there's other assets that we could use to fund an ILIT to replace some of that wealth that would be lost from estate taxes due because of the inclusion of that $15 million of stock in your estate. But I really wanted to put some numbers to this idea of what it means to gift an appreciating asset to your kids before you pass away and what that means to them in the future. So if we were to gift that $5 million of stock to our kids, and use, part of our lifetime exemption in order to gift that to the kids, we are avoiding paying any capital gains if we wanted to sell that stock while we own it, which in these numbers, we are only considering federal capital gains tax. They would also be taxed at the state level, depending on where you live. So this is just federal level capital gains taxes that we're making these calculations on. So you, as the owner of the stock, avoid about $950,000 in capital gains. But by the time, fast forward 20 years at your passing, your kids own that stock. It's worth 15 million, but now they have $2.4 million of embedded long-term capital gains within that stock, meaning that if they wanted to sell that stock at the time of your passing, it's really only going to net them about, $12.5 million or so, because they have to pay capital gains tax on this gift that you've given them. Option two, we wanted to kind of run some numbers and show you what kind of meeting in the middle may be, because there is something to be said for, wanting to maximize the gift to your children, but maybe you also don't want to give them the flexibility to have this, $5 to $12 million immediately. So what would it look like if we were to sell part of that stock while we own it, while we're alive, use the proceeds from that stock liquidation in order to fund an ILIT, and then give the other half to our kids at passing? So in that scenario, we're selling half of the stock, we're paying half of the capital gains that we would have due. So $476 is our capital gains tax due. We're using the proceeds from that sale, about $1.75 million, over the course of 10 years. To Christina's point, we'd probably fund a life insurance policy over an extended period of time, using those proceeds to pay the premiums of, or essentially gift that money into an ILIT, so the ILIT can then buy a policy on our lives with a $5 million death benefit, right? So we have now used, in this scenario, 1.75 of our annual gift exemption versus 5 in the previous example, because we've only funded 1.75 into the ILIT. But we have gotten about $10 million out of our estate between the value of the stock, the cash used to pay the premiums, and the cash that we use to pay the capital gains tax. So we've still decreased our estate, used much less of our lifetime gifting exemption. Our kids still end up with about the same net effect of $12.5 million between the value of the stock they inherit plus that death benefit. But the real difference between these two scenarios is that you have preserved more of your current, being, over the next probably 2.5 years, lifetime gifting exemption available to you, which frees it up to do other strategies that you may want to consider.
As you're talking, I've heard it say that payment of death taxes is optional. And it really truly is. There are a lot of strategies that, given time, right? So these, you don't get rich overnight, you get rich over time. You eliminate death taxes over time. You don't do it overnight. So these are habits, these are strategies on a multi-year perspective, but it's very important to model this out. And this is, this is really fantastic. The other thing too that you're not mentioning is if somebody passes away 5 years later, you're going to get a death benefit, right? That's the other thing. And you may have a need for that liquidity to pay death taxes. If you've given that stock to the kids, they're going to have to sell their seed corn, pay capital gains tax to fund the payment of the death tax. You see where I'm going with that? So if you give them the stock versus life insurance, so this is why this is modeled out with numbers. There's no one size fits all. This is definitely an individual thing. And you, both of you are really good at this, sitting down with the clients and saying, hey, let's run the numbers and model out a few options. You have this incredible depth of experience and knowledge, and the feedback I'm getting from people that that we work with together is that you guys do a fantastic job. So you gals do a fantastic job. So that brings us to the end of today. Any closing thoughts, closing remarks?
Yeah, Jim, what you just said reminded me of one thing that I think is real, that I would like to point out. And it's that our whole discussion today really has been around this estate tax exemption and that sunsetting. But I think that point that you made, hey, what if you pass away in 5 years, there's still that death benefit. Yeah. There is still value to be had, even outside of the estate tax exemption, of looking at some of these strategies, right? So that you're able to use perhaps dollars to leverage insurance, the insurance company, in order to create a legacy for your family, for example, in addition to some of those protections that we talked about, like creditor protection, if you've got special needs in your family. So yeah, we're talking about high net worth, but there's benefits beyond that.
All right. Well, we have offices in Northern and Southern California. And if you'd like to contact Ascent Wealth Management, their number is there, 805-312-7200. And our main number is 530-269-1515. And we will answer some questions here in just a minute. We do have an upcoming Spanish language. For those of you watching this, like, what the heck is this? This is not English. Conceptos básicos de la planificación patrimonial en español. Diego will be joining me, who is licensed in both Mexico and the United States. I happen to have studied in Spain for a year at a Spanish university. So I'm going to dust off my Spanish and do that with Diego. That is August 24th at noon. Very exciting. Very excited to do this. Many of our clients Many of our clients, their first language is Spanish, let's face it, right? And it's just a comfort level, right? For many people, obviously your documents are in English, but we're going to go over these concepts in Spanish. And if you're watching this on YouTube, go ahead and subscribe to our YouTube channel. You can click the bell and we will open it up for questions. And this is the point in the video. If you're watching this on YouTube or listening to it on YouTube, just keep watching because another video is going to roll right after this one. And if you're listening to this on the YouTube audio only version, another one will roll up, I believe, after this, but I'm not 100% sure. So if you're watching this on YouTube, keep watching. Thank you, Shannon and Christina, for joining us here today. Stick